Time's up. By far, the biggest IPO on record is almost here. If current reporting is right, SpaceX could list on NASDAQ as early as June 12th under the ticker SPCX at a possible valuation of around $1.75 trillion. And it is not coming to the market as a normal IPO. It is coming as a gravity event. A company that started with rockets now sits at the center of 4 markets at once: launch, satellite internet, defense infrastructure, and AI. That would not just make it the biggest space company on the public market, it could force investors to rethink how they value the entire space economy. So the real question is not only, should I buy SpaceX? The better question is, what gets repriced around it? Because when the dominant company in a sector finally goes public, the market starts looking for public companies that rhyme with the story. So in this episode, we are not chasing the IPO hype. We are asking a cleaner question. Which companies could benefit from the capital flows behind SpaceX? And there are 3 names that stand out. Let's start with what we actually know. The company has moved into the formal IPO process with a public filing now visible and current reporting pointing to a possible June listing. The proposed ticker is SPCX. The target raise is around $75 billion, and the target valuation is roughly $1.75 trillion. If completed near those numbers, it would be by far the biggest IPO on record. But there is a catch. At that valuation, SpaceX is not being priced like a normal aerospace company. It is being priced like a company that could dominate several future markets at once: launch, satellite broadband, defense communications, connectivity, Starship, and also AI infrastructure. The key point is this: SpaceX is no longer just a rocket company. The most important segment is connectivity, driven by Starlink. It generated about $11.4 billion in revenue in 2025, or roughly 61% of SpaceX's total revenue. The rocket business made SpaceX famous, but Starlink is what makes the IPO financially believable. And the operating scale is almost absurd. As of the first quarter of 2026, Starlink had about 10.3 million subscribers across 164 countries and territories. SpaceX also had around 9,600 satellites deployed, and one recent report said the company was producing around 70 Starlink satellites per week. Think about that. This is not a few satellites for science missions. This is industrial-scale satellite production. Then there is the space segment. That includes Falcon launches, Dragon missions, Starship development, government contracts, and deep space ambitions. And now there is the AI layer. After the X-AI combination, SpaceX also includes a very capital-intensive AI story. That part brings upside, but it also brings losses, capex, complexity, and governance risk. And the defense angle also just got stronger. SpaceX recently won a $2.29 billion U.S. Space Force contract to build a secure military space data network. That is not a small detail. It shows what SpaceX is becoming, a part of the military data backbone. So the simple version is this: Starlink is the cash engine, launch is the strategic moat, defense is the institutional customer, AI is the new burn engine. That is what investors are being asked to underwrite. This IPO matters because SpaceX is becoming the benchmark for the public space economy, and we are already seeing the market react. Space-themed ETFs have attracted roughly $1.3 billion of new cash in April alone. The capital is moving. Before SpaceX even started trading, investors are beginning to ask whether a SpaceX listing could force Wall Street to rethink how it values the industry. That is the real power of a SpaceX IPO. It puts the entire space sector back on investors' screens. Because when the leader moves, money starts looking for everything around it. Most investors still cannot buy SpaceX directly, so they look for public stocks with exposure to the same story. Not the next SpaceX, but pieces of the same trade, and that brings us to 3 names. Before going deeper, here is the short version. Rocket Lab is the launch and space systems name. It is the closest public market proxy for the launch side of SpaceX, even though it is much smaller. AST Space Mobile is the direct-to-device connectivity name. It is trying to build a space-based cellular broadband network that connects directly to normal smartphones. MDA Space is the industrial infrastructure name. It builds satellites, robotics, geointelligence systems, and mission infrastructure. That is the framework, not this is the next SpaceX, just which companies get their share of this huge capital flow. The first public name is Rocket Lab. If SpaceX is the dominant launch and systems platform, Rocket Lab is the closest listed company with a similar shape, not similar scale, but similar direction. Rocket Lab launches small payloads through the Electron rocket. It is developing the larger Neutron rocket, and it also operates HASTE for hypersonic testing. And it also builds spacecraft, satellite components, propulsion systems, and mission hardware. That is important because Rocket Lab is not just a launch company anymore. It is trying to become a vertically integrated space infrastructure company. The latest numbers support that story. In the first quarter of 2026, Rocket Lab reported record quarterly revenue of about $200 million and backlog of more than $2.2 billion. It also guided for another record revenue quarter. That gives Rocket Lab a real industrial base, but the big catalyst is still Neutron. It's what could make it strategically relevant at a larger scale. If Neutron works, Rocket Lab can compete for bigger payloads, constellation launches, national security missions, and more integrated customer relationships. If Neutron slips, the market will punish the stock. So the Rocket Lab thesis is simple. It is the closest public launch and space systems proxy to SpaceX. The upside is vertical integration. The risk is that the valuation already assumes a lot of future success and more integrated customer relationships. Rocket Lab gives us the launch and systems angle, but the juiciest part of SpaceX is Starlink, global connectivity from orbit. And that brings us to the highest beta name in this basket, the AST Spacemobile. It is the most speculative name here, but it may also have the cleanest story. The company is trying to build a space-based cellular broadband network that connects directly to normal smartphones. No special terminal, no Starlink dish, no extra hardware, just your existing phone connecting to satellites overhead. That is the hook. AST says its network is designed to connect directly to standard mobile phones through partnerships with mobile operators. If it works, AST is not selling internet to a niche satellite user market. It is potentially selling coverage to telecom operators that already have huge customer bases. That is a very different model from Starlink, which mostly sells connectivity directly to households, enterprises, ships, aircraft, and governments. AST is trying to become a wholesale space layer for mobile networks. The numbers are still early. In the first quarter of 2026, AST reported revenue of about $14.7 million, while losses remained heavy, but the company still targeted roughly 45 Bluebird satellites in orbit during 2026. That is the bull case, but the risk is also very visible. One recent Bluebird satellite failed to reach its intended orbit after a Blue Origin launch issue. That is not necessarily fatal to the thesis, but it shows exactly why this stock is risky. AST is trying to build a telecom network in space. That means manufacturing risk, launch risk, spectrum risk, capital risk, and customer conversion risk. So the AST thesis is simple. It is the direct-to-smartphone satellite broadband bet. The upside is enormous if the network scales. The risk is that the company is still early, heavily loss-making, and dependent on execution. So Rocket Lab gives us launch, AST gives us space-based connectivity, but there is a third way to play the space economy. Not by owning the network, not by owning the rocket, but by building the infrastructure. That is where MDA Space comes in. It is the least flashy company in this basket, and that may be exactly why it is interesting. It is not a launch company. It is not trying to sell internet directly to consumers. It is a space infrastructure contractor. MDA works across satellite systems, robotics, space operations, and geointelligence. This is the picks and shovels angle. If more satellites are going up, someone needs to design them, build them, integrate them, test them, and support them. That is where MDA fits. Financially, it is also the cleanest business in this group. In the first quarter of 2026, MDA reported revenue of about 464 million Canadian dollars, up roughly 32% year over year. Adjusted EBITDA was about 91 million Canadian dollars. Backlog was 3.7 billion Canadian dollars. That makes MDA very different from Rocket Lab and AST. Rocket Lab is still proving profitability. AST is still proving the network. MDA is already a scaled industrial space company. The contract base is meaningful too. MDA signed a contract worth about 1.1 billion Canadian dollars with Globalstar to build its next-generation low Earth orbit constellation. That reinforces the idea that MDA is not selling a dream. It is building actual satellite infrastructure for actual customers. So the MDA thesis is simple. It is the profitable space infrastructure name, less explosive than AST, less glamorous than Rocket Lab, but much more grounded in current revenue, EBITDA, and backlog. So let's reduce it. Why these three? Because each one maps to a different part of the SpaceX story. Rocket Lab is the launch and space systems name. It gives investors exposure to launch, spacecraft, defense contracts, and a potential step change if Neutron works. AST Space Mobile is the space connectivity upside name. It gives investors exposure to the dream of broadband from space directly to ordinary smartphones. That is the clean framework. None is the next SpaceX, but together, they represent three public ways to play the theme: launch, connectivity, and infrastructure. Now the risks. This part matters because space stocks can look very exciting right before they hurt investors. First, the hype risk is real. SpaceX is emotionally powerful. Those ideas attract capital, but they can also attract valuations that run far ahead of fundamentals. Second, execution risk is everywhere. Rocket Lab still has to prove Neutron. AST still has to turn technical promise into commercial revenue. MDA has to convert backlog into revenue. Third, a lot of this market depends on government and defense spending. It means politics, procurement delays, budget cycles, and national security priorities matter. And fourth, launches are still hard. Even great companies miss schedules. A single failed launch, production delay, or regulatory issue can move timelines by months. So here is the thesis in one line. The incoming IPO is not just a listing, it is a repricing event for the public space economy. SpaceX is the anchor. It has launch dominance, Starlink scale, defense relevance, and a new AI infrastructure layer. But at a possible $1.75 trillion valuation, investors need to be careful about how much future success is already priced in. That is why the public comparables matter. Rocket Lab is the launch and space systems play. AST Space Mobile is the direct-to-phone connectivity play. MDA Space is the infrastructure play. So the final framework is simple. If you want the launch story, look at Rocket Lab. If you want the connectivity moonshot, look at AST Space Mobile. If you want the picks and shovels infrastructure story, look at MDA Space. SpaceX may be the headline, but the capital flow is bigger than one IPO. This is capital rotation. We look for the capital flows behind the headlines.